Are we on the brink of another global banking crisis? The recent slide in global bank stocks has sent shockwaves through financial markets, raising fears of a repeat of the 2023 turmoil. But here's where it gets controversial. Could this be more than just a blip, and instead a sign of deeper systemic issues in the banking sector? Let's dive in. On Friday, global financial markets took a hit as U.S. regional bank stocks plummeted, triggering a domino effect across Asia and Europe. This sell-off wasn't just about numbers. It was a stark reminder of the fragility of the financial system, especially in the wake of disclosures from Zions Bancorp and Western Alliance. These banks revealed significant losses and fraud allegations, sparking comparisons to the Silicon Valley Bank collapse in 2023, which was fueled by high interest rates and risky lending practices. And this is the part most people miss. The current crisis isn't just about individual bank failures. It's about the broader implications for credit markets, particularly the booming yet under-regulated private credit sector. Companies have been borrowing heavily in recent years, and now credit impairments and default rates are climbing. Mark Dowding, CIO at RBC Blue Bay Asset Management, notes that default rates in private debt have hit 5.5%. With weakening investor protections exacerbating potential losses, J.P. Morgan Chase CEO Jamie Dimon's recent warning about credit markets, "When you see one cockroach, there are probably more," has only added to the unease. European banks led the losses, with Deutsche Bank and Barclays dropping around 6%, while Asian financial firms, particularly Japanese banks and insurers, also took a hit. Even big tech stocks like Nvidia saw declines, highlighting fears of a broader market contagion. This isn't just a banking issue. It's a market-wide reality check. But here's the controversial question. Is the AI-driven stock market surge of recent months a bubble waiting to burst? Investors have flocked to AI-related companies, driving valuations to record highs. European bank shares are up 40% year-to-date, and world stocks have risen 16%. Yet, periodic sharp falls and gains in safe haven assets suggest growing unease. Gold hitting a record high and the Swiss franc appreciating further underscore investor anxiety. The parallels to 2023 are hard to ignore. Back then, regional bank troubles sparked a global stock market decline. Today, investors are nervously assessing whether history is repeating itself. While big U.S. banks have reported strong earnings, high equity valuations, and geopolitical tensions, such as U.S.-Chinese trade disputes, are keeping markets on edge. So, what's next? Are we overreacting, or is this the beginning of a larger correction? Could the private credit market's risks spill over into the broader economy? And what does this mean for the AI-driven rally? These are the questions keeping investors up at night. What's your take? Do you think this is a temporary setback or a sign of deeper troubles ahead? Let's discuss in the comments.